Good morning and welcome to the RVW presentation, which we're deeply honored to be presenting in conjunction with BlackRock. Now, those of you who haven't heard of BlackRock probably ought not be on the show. Welcome to our friends from around the world. Good morning, good afternoon, and good evening. Just a brief outline as to who BlackRock are and then specifically who our guest presenter is today. BlackRock is the largest wealth manager in the world. They manage over $10 trillion of wealth around the world. They have 16,000 people working for them. They work in 82 languages in 38 countries, and they are the preeminent wealth managers globally. It is a deep honor, privilege for us at RVW to be affiliated with BlackRock. At the beginning, almost $1 billion ago when we started RVW, the concept was and will always be surround ourselves with the best brains, the best thinking, the best implementation, and bring that in a group to our clients. And that's what we've done and currently do. A brief word about our presenter. Mark Peterson is the Director of Investment Strategy and Education. He's a 20-year veteran at BlackRock, and his focus is on understanding and then educating. And that very much mirrors the RVW approach. We actually don't have a sales process. Our process is an educational process. And we're delighted that Mark shares that view of how one builds a business, the solid foundation, and then the education. We're not a bunch of predictors, forecasters. We know that they get it wrong almost all the time. We live in the current world, and the funds we employ from BlackRock are funds that currently reflect in a dynamic manner the selection of factors and attributes that have historically indicated higher expected returns. The particular fund we use from BlackRock is a quality factor fund, and it reflects companies that are selected to produce optimal combination of return on equity, low debt levels, solid balance sheet levels, and solid earnings growth. In other words, we view equity investing as numerically oriented and data-focused people would buy businesses. We don't think of ourselves as frantically trading pieces of paper in a stock exchange. We actually think of ourselves in the Buffett mold as owners of fractional interests in successful businesses. That's what we seek to do, because we know that in time, the driver of prices is the profits and the strength of those profits. There is a quote which says, successful sport people focus on the field and not the scoreboard. We focus on the field. And today we're going to have a lesson in how one does that from one of the experts. It's an honor, a deep privilege for me to introduce Mark Peterson to us today. Thank you, Mark. Thank you so much for being with us.
Great. Thank you. Good morning, everybody. Thanks for having me on your call here. I'm going to try to share my screen so we can pull up some slides here. Let me know if that does not work. Is that working? There we go. Hopefully that works. Yeah, somebody yell at me if that is not working, but we do have some charts and graphs for you today. I'm kind of a chart and graph guy, so I can't help myself. Obviously, not a shortage of information and challenges that we face with the markets and the economy out there. So we'll try to give you a little bit of a recap of where we've been and more importantly, where we're headed here in 2022. So let's start just where we've been. I think it's interesting to think about the last couple of years from a stock and bond return standpoint. It's probably hard to remember anything prior than 2020, right? Everything before the pandemic seems like a lifetime ago. 2019 was a really good year for stocks and bonds. Stocks up 31.5%, bonds up 8.7%. And then 2020, stocks finished up 18%. It was a wild ride to get there, right? We were down 30% at one point in the first quarter, and bonds up 7.5%. And so both calendar years back to back, really good for both stocks and bonds. And that's pretty unusual historically. If we just look back and went back in the old time machine, going back to 1926, there's only 4 other calendar years in which we've had back-to-back calendar years where returns for stocks and bonds were as good. So well above average for both stocks and bonds for both 2019, 2020. Of course, this is a good news, bad news story, right? Good news is we've had some really nice returns. The bad news is history tells us there's no third year here. And that's exactly what happened last year. Stocks continued to do well, right? Powered by somewhat of a restart across the economy, certainly by earnings, certainly by low interest rates. But bonds didn't do quite as well, which was probably more expected given the fact that base interest rates are around 1.5%. And certainly not able to maintain 8 and 7% bond returns, given that backdrop. So we had a feeling it had to give, right? Something had to give. It was most likely going to be on the bond side. And that's exactly what happened last year. So certainly think about how that sets up for 2022. We've had a really good year for stocks, right? 3 years in a row. Bonds bouncing off a negative calendar year return, which we'll talk about, which is pretty rare to get a negative year return for bonds, and very rare to have 2 years in a row in which we have negative returns. Stepping ahead, thinking about just the stock returns, 3 calendar years in a row of stock returns. And the average is about 26% historically. So you can see 26% over that 3-year calendar window from 2019 to 2021. And it ranks 8th best historically, again, going back 95 years. So pretty rarefied air. And keep in mind that anything over 24% over a 3-year period of time, you double your money. So if we just remember the rule of 72, divide your percentage return into 72, and that's how long it takes. So you've more than doubled your return over this 3-year calendar window. And that's pretty historically rare when you look at it. When the average historically is around 10.8% for stocks per year. And you can see what the next 3 years did. So we wanted to lean on history, right? It's the old Mark Twain, history doesn't repeat, but it often rhymes. What did stocks do the next 3 years following such a good historic run for stocks that we've seen here? You can see it's very much of a mixed bag. You've got 4 returns here following that were negative, 4 returns that were positive, and 1 that was roughly break even or 0. So you can see a little bit all over the board. And we have time periods all over the calendar as well here. We have a couple in the mid-90s, right? That tech bubble leading up to the tech bubble, where depending on which time period you're talking about, the next 3 years really varied, right? The further you got away, that 95 to 97, best 3-year window in history. The next 3 years weren't too bad either, because you still had a little room to run before the end of the tech bubble there. But you have other periods here as well. You have the Great Depression in here, which certainly looks bad. I think one period that's interesting is the 1950s. You got the 1950s a couple times in here. The 1950s are somewhat comparable to today, just because interest rates are so historically low. This is the last time we saw interest rates as low as they are today, is back in the 1950s. And we'll talk about that in a little bit more detail towards the end. But I think that's interesting just from a comparable standpoint. You can see the returns following some of those mid-1950 run where stocks had some really great historic returns. The next 3 years were actually double-digit returns as well, as stocks continue to do well, as we had very low interest rates. So certainly if you're looking for return, stocks were the only game in town. I think we had that a little bit of that flavor today as well. Very tough to find returns out there other than the stock market, just because interest rates fundamentally are so low. Now, we mentioned bonds having a negative year. It's actually the 4th worst year ever for bonds in 2021. So just thinking about, why we own bonds in the first place, I think that really captures it, right? When you think about we own bonds for safety, stability, income. And the fact that the fourth worst year ever is actually only down 1.5% really speaks to what bonds do in a portfolio, right? That's pretty darn good. Down 1.5% is a pretty bad day in the stock market, right? But that's a year we're talking about for the bond market. So certainly speaks to why we own bonds in a portfolio. You can see the worst years ever. 1994, we were down a little bit less than 3%, which I think is interesting. But looking at the fact that if you strip out income, the year wasn't that bad. And just this really highlights the fact that the returns that we saw last year for bonds were really a function of the very low interest rate environment we're living in. So if we just break out the income portion from the bonds versus the price return portion, you can see that it was only the 20th worst year for bonds historically. It's just the fact that interest rates are so low, we're just not accumulating income for bonds like we would in previous periods when interest rates were much higher. So that's just some of the base fundamental reality that we have in today's world, that interest rates are driving lower bond returns because that income portion is so much lower than what we've experienced in the recent past. So I wouldn't be shocked if we saw other years start to break into this top 10 worst bond years ever, right? As we start to break out of a low interest rate environment, we'll probably have other entries here in coming years. Maybe it's not 2022, but it might be in a future year as well. It's just the reality of a low interest rate world. And of course, one of the big headlines that everybody's talking about is what the Federal Reserve will do with short-term interest rates. So what happens with short-term interest rates here? I think the market is priced in that the Fed is going to raise rates 4 times by about 1% total, so about 0.25% at a time. And that certainly would be different than where we've lived the last handful of years. We haven't seen the Federal Reserve raise short-term interest rates since 2015. You can see the chart. We have the last 4 times that they've raised rates, or at least initiated raising short-term interest rates. And you can see we added, what do stocks and bonds do the next 6 and 12 months? You can see not terrible returns. They're still positive, but they're certainly not like we've seen the last 3 years, right? 7% over the next 12 months for stocks, 3% for bonds, certainly well below the historical average as well, but not negative returns. And I think that's what we're faced with this year. Higher short-term interest rates certainly put a ceiling on stock and bond returns, given the fact that those interest rates will go up, make stocks look a little less attractive in the near term, certainly has the potential to slow the economy as well. And that's certainly, I think, what's on everybody's mind. Now, the question is not just, will they raise rates? It's how many times they raise rates. I mentioned the market's priced in 4 price increases. I think I'd probably lean to that they'll do less than 4. I think you're faced with 2022 at some point, especially in the later half of the year, you're going to have inflation start to settle back, and we'll talk a lot about inflation. And we'll also have the economy starting to settle back as well. So it's hard to imagine the Fed being really aggressive if inflation's retreating, if the economy's settling in to lower growth levels. It's hard to see them being super aggressive. So I'd probably lean closer to 3 than 4 at this point. But this has been a moving target, no question about it. I think this is one reason why we've seen the market sell off a little bit here in the last couple of weeks, is because they've built in more rate hikes by the Federal Reserve here in 2022. One reality that we've talked a lot about within our student of the market piece is there's a lot of cash on the sidelines, right? We just haven't spent money like we normally would, right? We just haven't gone out. We haven't traveled like we normally would. Certainly have saved more probably than we normally do. And certainly there's a lot of federal stimulus in the system, right? We've pumped a lot of cash in the system, and you're seeing that cash in all kinds of places. One of the places is cash on the sidelines, these money market accounts that are earning nothing, by the way, losing to inflation at a greater level than they have in 70 years. Yet there's still $4.6 trillion with a T in money market funds, cash on the sideline accounts today. That is pretty amazing. It's we saw the peak last May at 4.8 trillion. We're actually at 4.7 trillion at the end of December if we updated this chart. So clearly still a lot of cash in the system. And you can see the other times we've had a lot of cash, kind of a buildup, a very distinct peak in these cash on the sideline accounts where folks are a little bit concerned about the direction of the economy, the direction of the markets. It happened during the previous peaks where the financial crisis in January of 2009, January of 2003 was the tech bubble bursting in 9/11. So very distinct peaks in cash on the sideline accounts. This time around, a little bit different because cash certainly isn't paying anything. You can see what stocks on the right did following those previous two other peaks. So generally, when you get cash on the sidelines, it's very positive for risky assets in the near term, right? You just see if the stock market sells off, you get all this cash on the sideline that starts to get put back to work, very supportive of prices in the near term. And that certainly worked out really well in the previous periods. Now, the one caveat I'd say right now is that stocks aren't as cheap as they were back in 2009 or 2003, right? Think about following 2003, stocks had actually lost money 3 years in a row from 2000, 2001, 2002, right? Believe it or not, stocks can lose money 3 years in a row. Stocks were really cheap at that point in time. Same thing with the global financial crisis. We've had a really nice 3-year run as we started with, as we mentioned earlier, in the stock market. So a little bit different disconnect, but I think we'll see this tug of war play out over time. Just looking at what drives the market, right? All this cash on the sidelines or the fact that stocks aren't cheap, right? And I think we'll see a little bit more volatility in 2022 just as the market works through that dynamic where a lot of cash on the sidelines, but stocks aren't cheap. How do we find value? One of the areas certainly within the stock market that's got some interest is some of those value stocks. So some of those energy stocks have had a big bounce back here recently, financial stocks as well. And it's been one of the big stories of the market, just this really another tug of war between value stocks, some that tend to be cheaper in nature versus those growth stocks, those technology stocks, a lot of those stocks that really carried us through the early parts of the pandemic. And you can see the last couple quarters, how it's been kind of this tug of war between value outperforming and growth outperforming. Growth outperformed the last half of last year and the last quarter as well. So we've seen this tug of war go back and forth. Really started with value when the vaccine news came out last fall. Back in 2020, at least in the fall of 2020, value stocks rebounded in a big way because they'd underperformed so drastically as there was concerns about the economy, how long would the shutdowns last, etc. The vaccine provided hope that there'd be more of a durable restart in 2021, which we did see right out of the gate. But of course, that faded as 2021 came about, right? And we saw other variants come around. Certainly, there's some hope this year, right, with the new variant being less severe, that we might be getting closer to a more durable restart more consistently across the country. And that's why value is actually off to a great start here in 2022. But really, we need to focus on, I think, a little bit bigger picture here. Just looking at 1-year rolling periods for growth versus value. You can see that last, or at least in 2020 in August, that was the biggest growth outperformance in history. It was even bigger than the tech bubble back in February of 2000. And the nature of growth versus value stocks tends to revert back, right? So if you get a big swing one way, it's going to swing back like a pendulum does the other way in the not so distant future. So you can see by February of 2000, you had the big growth outperformance, but then it swung back in June of 2001, and you had large amounts of value outperformance. I think we're really set up to see something similar. Maybe it's not as dramatic as June of 2001, but I think we're set up well for value moving into 2022 as the economy starts to restart, as those value stocks really get some more solid footing. I think we'll see a more sustained value rebound. Now on the bond side, Certainly, we mentioned low interest rates several times early on. This is the longer-term picture of interest rates and bond returns going back to the 1920s. This is one of my favorite charts just because it does a great job capturing how interest rates and bond returns are connected, right? Wherever interest rates start, that's generally where bond returns finish over the next 10 years, right? So look at where the red line, which is interest rates, intersects with bond returns by decade, right? That yellow bar. You can see right the 90s and 2000s are almost perfect, right? Interest rates started around 7%. You finished right around 7.7% in the 1990s for bond returns. Same for the 2000s, right around 6%. You finished at 6.3% for bond returns for the decade of the 2000s. Of course, the challenge today, if interest rates are right around 1.5%, 2%, I think we're right around 1.8% this morning. That means 10 years from now, we're going to look back and we're going to see 1.5%, 2% bond returns for the decade of the 2020s, right? The next 10 years, bond returns can be pretty predictable just based on where our starting interest rate is. So that's a challenge, right? That's very different than the return environment, that yellow bar environment that we've lived in over the last really 60 years, right? You really have to go back to that 1940s, 1950s, post-Great Depression, post-World War II era to find a period where interest rates were as low as they are today, where bond returns are going to be as low as they are here in the 2020s. You have to go back 70 plus years. And that's clearly a challenge that we're faced with. We're all faced with portfolios. And I think it's the ultimate financial irony, right? If you think about it, you have all these baby boomers retiring, looking for income, looking for safety. And look at the picture of that income and safety asset class, right? Bonds are the income, safety, stability asset class. And this picture is more challenged than it's been in 70 years. I just think that's an enormous challenge that we're faced with portfolios. Certainly, there's some things we can do here. And there's no silver bullet. There's no simple answer, just buy this solution or move more into your portfolio in this solution. It's about owning a lot of different things that can help both build return on such low interest rates, but also manage risk so you're not taking on too much risk, right? It's easy to move away from bonds and take all kinds of risk, but you need to make sure that you still maintain that safety, that stability, that income that that bonds provide. And that brings me around to the diversification story. This is a chart that we use quite often. Great reminder why we build portfolios the way we do. Looking at a diversified 60-40 portfolio, so 60% in stocks, 40% in bonds. I know everybody have a little different portfolio based on where you're at in your life cycle, where you're at from a risk tolerance standpoint. But a 60-40 is just a kind of a good benchmark to use. And we look at it relative to the U.S. stock market, so the S&P 500. And we just look at the fact that the diversified portfolio can be tough to own because it never feels good or it rarely feels good, right? There's very rare periods of time, and we've seen some of these back in the 2000s where diversification works and it's easy to see the benefit. But there's in more recent periods, you've had periods of time where diversification didn't look so good, where 2008 being probably the best example, right? Where you lost 26% in the diversified portfolio in a single calendar year. Probably one of the worst calendar years ever for a diversified portfolio, down 26%. That never feels good, right? To lose a quarter of your assets in a calendar year, that's pretty painful. Then when the bull market returns, and probably no better example than this, than 2009 to 2019, the S&P 500 up 350%, but the diversified mix, you were only up 220, right? So you left 130% on the table because you diversified across asset classes. That doesn't feel so good either. Excuse me. And that's the dynamic we see so often with the diversified portfolio. I often joke with folks that you have a really well-diversified portfolio if it never feels good, right? If it never feels good, you probably have a pretty good mix of asset classes because you get this dynamic going. And you can see the last couple of years, we've had this dynamic play out, except in a shorter time period, right? Where you still lost more money in the first quarter of 2020. And the last 15 months of 2020 and 2021, you trailed in a big way, right? You can see 119 to 66%. That doesn't feel so good either. So we've got this dynamic. We need to understand emotionally how challenging this can be. Of course, the punchline here with my fancy animation is the fact that if we add up this, and this is a little bit more than a 20-year stretch, right? This goes back to 2000. So a little bit more than 20 years. And if we added all these periods together, the diversified portfolio actually outperforms. And does so with a heck of a lot less risk. We don't even capture the risk here. But you can see it actually outperforms with less risk. This is what we call at BlackRock winning more by losing less. Winning more by losing less. You don't need all the upside of what the bull market brings if you do a better job to the downside. It's just tough emotionally to connect those dots because it just never feels like you're getting ahead. And again, for us, it's just a great reminder, even for some of the best investors we work with across the country, great reminder why we build portfolios the way we do, right? Why we asset allocate, why we diversify across different asset classes, why we spread your investment eggs across a variety of investment baskets. It's all to get to this winning more by losing less story. And we just like to pull back, take a step back and connect those dots so everybody can remind ourselves of that story. Now let me finish up with some inflation news. Of course, inflation grabbing headlines. The folks at RVM know that I'm an inflation geek, so every time I can work in inflation, I do, and it's good to be back in favor as an inflation geek. I'm a hit at all the cocktail parties again, but inflation is a challenge here moving into 2022. Really, we haven't seen this high inflation over 40 years. I think that you'll see that in the headlines. Actually, last week we had an inflation number that was over 7%. So over 7% for inflation. That's the highest in 40 years. And one part that the news is leaving out of the story that I think is just as important as those high inflation numbers is the fact that interest rates and savings rates aren't keeping up, right? Interest rates and savings rates are nowhere near 7%, right? You can see here at the end of November, the 10-year U.S. Treasury bond yield, kind of that base interest rate, was only at 1.4%. It's gone up a little bit. We're at 1.8 now today, but it's still the largest gap between inflation and interest rates that we've seen since May of 1951. So over 70 years of history since the last time we've seen a disconnect between inflation and interest rates. This is the story in 2022. This is what the headlines are really missing, is the fact that so much more challenging in today's environment when interest rates and savings rates don't keep up, right? When we get that period of higher inflation and interest rates aren't keeping up, more challenging than ever on portfolios, right? Really, and the only solution here is to have a well-diversified, well-thought-out investment portfolio, right? All those folks with cash on the sidelines or really conservative portfolios are losing out to inflation like they haven't in 70 years. And I think that's a story that we need to ring the bell on a little bit more here in 2022, because this is not going away anytime soon. And it's going to be more challenging for investors, especially those folks at the very conservative end of the spectrum. Right? Again, a lot of those baby boomers who are looking for safety, looking for income, they're more challenged by low interest rates and higher inflation than they have in 70 years. And one of the pieces that's fascinating, I think, with inflation is the housing market. The housing market, you're seeing all kinds of inflation. We're actually seeing the highest gains in housing prices in history. So up over 20% in the housing market. Some areas, I'm sure we've got some folks who live in areas that are even seeing higher gains than 20% year over year. And it's interesting from an inflation standpoint because housing prices actually aren't in the inflation calculation anymore. They actually took out housing prices way back in 1983 because they wanted to reflect the fact that even though housing prices were going up, interest rates were coming down and it was getting cheaper to finance and buy a home. So they took out housing prices in 1983 and replaced it with what you'd rent your house for, what they call homeowners equivalent rent, which is a fancy word just to say what you'd rent your house for. And it's a crazy dynamic because rent and housing prices are completely different animals, right? You can see the yellow line is rents. And I don't know if we have any landlords on the call, but landlords know it's really tough to change rents, right? You can change housing prices. If you have your housing price, on the market, you can change it daily if you wanted, right? But it's really tough to change rents because rents tend to be extremely stable, right? If you have somebody in the residence for a while, right? You don't want to raise their rent, or you sign them to a longer term lease that's locked in. Very tough to raise rents up or down. So that yellow line tends to look like the dead man's EKG, where the housing price number, right, has gone all over the map. So this change in 1983 has taken a lot of the housing price volatility out of the inflation market. And it's actually the largest single component of the inflation calculation is this what you'd rent your house for. So imagine what inflation would be today if we had housing prices back in, right? So instead of 2.4% inflation, it's higher now. Rents have ticked up to 4%. They tend to lag housing prices. But imagine if we had 20% in there for this largest component of the inflation calculation. We'd be talking double-digit inflation, not 6 or 7% inflation. We'd probably be talking closer to 15% inflation, which I think it feels for a lot of folks out there, especially if you're a first-time home buyer trying to chase these home prices down. So I thought that was just an interesting dynamic that gets lost when people talk about inflation, that we no longer have housing prices in there. It's only rents, and that certainly brings down that inflation number comparable to what we saw in the late 70s, early 80s. It's really not your parents' or your grandparents' inflation calculation. Here's a breakdown of the inflation index. There's 8 different categories, actually. You can see housing makes up 41% of the index. So everybody likes to talk about food and energy prices, right, because they tend to be pretty volatile, but it's still a housing index for the most part, right? 40+% is housing. That's enormous. If you look, food is about 15%. Transportation, which is a lot of energy, is 17%. So those 3 sectors make up over 75% of the index. Very, very driven by those 2 categories. One thing that I think is interesting here, 2 categories where we've normally seen a ton of inflation, medical care and education. Normally those are 3, 4, 5% inflation numbers. Those have been really subdued during the pandemic, right? We're seeing medical care at 0.4, education at 1.2. I think those numbers are going to start to revert back here, especially towards the end of 2022. I think some of these places are going to get back to their longer-term inflation trends, which will be pressure on the inflation index going forward. I think when you hear about inflation, you'll hear about some of the things within the index that are temporary, things like lodging away from home, right? Those hotel prices, those will settle back in as the further we get away from the pandemic. But there's other items within this calculation that we think will revert back and remain high in 2022. So we expect inflation to come down from that 6 and 7% level, especially in the second half of the year. But that doesn't mean it's going to come back down to that 2% level that we've been used to over the last handful of years, right? It probably settles more into that 4 to 5% range, with a lot of pressure from housing, a lot of pressure from some of these other items. I think increased pressure from healthcare and education as well. Here's the food breakdown. Everybody always likes to talk about some food prices, right? You can see some of my favorite items on here. Bacon up 19%, unfortunately for me. Food away from home is one of the big categories. That's anytime you eat away from, eat outside the home, so restaurants and fast food. That limited service meals on the far bottom right, that's actually 6.7%. That's fast food. That's the largest gain in fast food prices in history. And it's all because not only food prices are going up, but it's also costing them more to get employees to show up and work, right? Certainly in the pandemic, that's been one of the big stories. You're seeing it flow through to higher prices within fast food. So this is another area that's going to probably be challenged throughout 2022 with higher price pressure. So certainly keep an eye on food. But I think I'm on a charts, believe it or not. Hopefully that was helpful. Think about where we started, right? We've had a really good 3-year run, especially for stocks. We knew that had to give on the bond side, and that's what happened last year. We're off to a slow start again on bonds. Certainly something to keep an eye on. certainly challenged in the reality of a low interest rate world. For stocks, we think it's a little bit more of a positive backdrop, just given all the cash on the sidelines. We think value is poised to have a good 2022. The bond side of portfolio is going to continue to be the challenge, though. Just the reality of that low interest rate world, right? Remember the fact that, right, we haven't seen interest rates this low since the 40s and 50s, coming out of that Great Depression, World War II era. And now we've added on higher inflation as well, really that double whammy, if you will. Not only are interest rates low, now we're seeing higher interest rates erode into those folks that have the most conservative portfolios. Really, again, like we haven't seen in over 70 years. I think that's going to be one of the big stories in 2022 is how do you deal with that reality? The only solution is to have a good, well-diversified, well-thought-out financial plan. I can't ring the bell on that enough. Probably in our lifetimes, it's never been more important to have your finances really well thought out, because you're losing to inflation. You have low interest rates. There's no other solution for that reality. And one of the challenges with inflation is the government doesn't send you a statement showing how much your purchasing power has eroded, right? You'll see the headlines, but you'll never get that statement showing how much your purchasing power has lost in the recent period. So inflation can be that silent thief. And I think we're seeing that happen really over the last year, and it'll continue to happen, and hopefully it'll retreat at some point in 2022, but it's still going to stay at elevated levels. So why don't I stop there, see if there's any questions, comments, thoughts out there. Love to hear what's on everybody's mind.
Mark, it's always a pleasure to have you. It really feels like you're part of our team, because what you said, the key to current low interest rates as well as high inflation is really a well thought out, diversified portfolio and strategic asset allocation. And as part of our RVW process, I mean, that's what we discuss all the time with our clients, especially as we're doing a year review in 2021. That's what we've been discussing heavily. So thank you for that. And speaking of our RVW Wealth process, we discussed the importance of investing into the markets as long as the investment time horizon is long-term. And one of the statistics that's really eye-opening, you covered it, is lots of cash on the sidelines, 4.7 trillion in money market funds as of December 2021. From your perspective, how do you think that will affect the stock markets, given that people will realize they're continuing to lose purchasing power and so forth? How do you think the dynamic will play out in the next few years?
Yeah, I think that's a great question. I think it's been fascinating. We thought those dollars would come out a lot quicker, right? Just because they're not earning anything, right? Losing inflation, as we touched. Similar to what we saw in 2009. If we pulled that slide up, that 2009 peak was really distinct and sharp because, again, interest rates became very low. Those dollars didn't earn anything. They were quick to return to the market. Maybe the pandemic, certainly lingering around, still being a challenge, has kept those dollars on the sidelines. But I think we've seen pockets where the stock market's pulled back. We had one in the fall, right, where the stock market's down maybe 3, 4, 5% in a month, and you start to see some of those dollars come back in, right, and use those as an entry point to get put back to work. So I think that's the tug of war I touched earlier, is the fact that you might see periods of time where stocks sell off, but then all of a sudden some of that cash gets run in to get put to work. So tends to be supportive of prices in the near term, right? So I think we'll see that dynamic kind of tug of war back and forth in 2022 here.
Right. And we also really appreciate the fact that you brought up, hopefully with a good strategic asset allocation, you could win more by losing less. And as part of our investment committee discussions, that's something we do focus on. Some of the metrics we use with you guys, especially looking at some of the factors, that's whether looking at, what's the profitability like? What's the earnings growth like? Is it stable and so forth? So obviously that's one of the funds we use. Looking at that, I think a really good example is, examples like NVIDIA, which is a little bit more technical. And then you have the Costco's of the world, which everyone would recognize. Can you just talk a little bit more about the profitability aspect of it, the low debt aspect of it, and how those get included in more the factor-based strategies that we use?
Yeah, no, absolutely. I think it's a great point. You mentioned quality early on in the call, and we touched it I think it's a great example, right? What you're looking for in today's environment, right? If you're looking for, and I often think of it as you're looking for companies that'll do well if the market has that pullback, right? You're looking for those stocks that'll be more durable over difficult economic environments, right? Those tend to be good, high quality companies that are profitable, that are predictable, right? That's, I think those are really the key pieces. And I think that's what should be a focus of portfolios, is just some of those strategies that'll do well if the market pulls back, where we still want exposure to the stock market, right? But maybe we build in some of that downside protection. I can tell you guys are probably a little bit of an outlier here. I think when we look across the country and we look at advisor portfolios, they don't have enough of these type of factors in their stock allocations, right? Which will do better in a downturn. So I think that's really critical moving into 2022, where we want to start to think about that protection. It's really easy when the market's up 26% on average the last 3 years to get pretty complacent with your stock portfolio, right? When you go through some of the better periods of time in stock market history. But it's probably the time to think about building in quality, building in some of those factors that'll hold up in a difficult market. So yeah, it's certainly something that we're trying to echo across the country.
Right. And speaking of quality, that's something I think a good way to protect yourself from some of the inflation figures that we're seeing. You know, what asset classes have you seen that performs well in a high inflationary environment?
Yeah, you know, last year probably being a great example, it was a perfect environment, I think, inflationary for both stocks and for Treasury inflation protected bonds, because what you had happen is you had inflation spike, which was a surprise for most, but interest rates didn't go up that much. The Federal Reserve didn't move short-term interest rates. So you had this dynamic where you had higher inflation. These companies could pass along costs, but they weren't hurt by higher interest rates in the short term, right? And the same thing with Treasury inflation protected bonds, right? If folks recall, these are the bonds that adjust higher with inflation. So they had benefited from the fact that inflation was higher, but they didn't get hurt by the fact that interest rates went up, right? Or interest rates went up, but only marginally. So it didn't hurt those Treasury inflation protected bonds from an interest rate standpoint. So it was a little bit of a Goldilocks period for both stocks and those Treasury inflation bonds. Certainly commodities are a category that our traditional inflation fighter held up well. You can see the energy sector, right, in the stock world. You're seeing those energy prices really come up. Energy was the best performer from a sector standpoint last year for stocks, after being the worst performer for a couple years in a row. So certainly that's an area that's seen a rebound and benefits from higher inflation. But certainly I think, you know, alternative asset classes are another area that that'll get more attention as inflation goes higher. But those are just the sampling. Generally, stocks do pretty well in a higher inflation world. That might be a little bit tougher in 2022 if we see interest rates come up a bunch. And I think, again, that's driving some of the recent volatility here, is folks thinking about how much the Federal Reserve is going to raise short-term interest rates. That acts as a brake on the economy, a brake on stock prices a little bit, or at least puts a little bit of a cap on the potential return in 2022.
Right. And, you know, thanks to your wisdom and all the clients that are with us, you know, have continued to stay invested, especially after our good meeting last year. One of the things that we also focus on is, and we're getting a lot of good questions, is financial planning. And as part of that financial planning, it comes in discussions of, again, really focusing on what really matters in terms of having exposures to different parts of the market, as well as tilting certain ways where you would really evaluate certain factors before buying businesses. Now, coming back to financial planning, how do you really see the inflation assumption playing out for the next several years? I think that's on top of a lot of people's minds. And again, how do you situate it? Because it was really looking at between 2 to 2.5% for quite some time. It looks like it's getting pushed up.
Yeah, no, I think this is a great question. We're talking a lot about it within BlackRock, right? I think forever, right, really the last 30, 40 years, we average between 2 and 2.5% inflation, right? So I know for a lot of financial planners, they would use 3, right, just as a kind of a rounding error. And some, you know, even more extreme, right, if they were trying to build in a little bit more of a safety net, might have used 4. That was probably the outlier. It was probably 3 was the common assumption. But you start thinking about the difference. What do you build in today, given a 6-7% inflation number, right? The market is kind of priced in still closer to 3% over the next 10 years. So they think inflation is going to come back down. I think, right, I think it's going to stay at elevated levels above that 2 to 3% range, right, where I think the new range might be 3 to 4% over the next 10 years, a little bit more challenged, especially on the housing market side. Don't underestimate that. That's going to linger for many years. So I think we're really going to have elevated prices for a while. So maybe the new number's 4 to be safe, or maybe a little bit more than 4. But I think it is a great question because it does start to change the math, right? I think we all know, especially if you have a longer term investment time frame, right? You start to change those inflation assumptions. All of a sudden, that hurdle that you have to get above to really maintain purchasing power, that hurdle, even from 3 to 4, that's a lot higher, especially when interest rates are as low as they are. So I think you're right on. I think we have to dial it up. I don't think there's any way, reasonable way that we can say 2 and 3% still makes sense in today's world.
Yeah, great point, Mark. And as you know, we're very data driven. Everything we look at is really science based, and we really like that chart where 1950s we're looking at some of the stock market returns. It was very strong. And clients are wondering for the next in a few years. Actually, on that chart, we saw that for the next 3 years, following strong returns, it was strong in the 1950s. You had mentioned that.
Yeah.
So, how do you see, based on the current environment, again with low interest rates, high inflation, how do you see some of the market areas or asset classes playing out for bonds as well as the stocks?
Yeah, certainly bonds are a lot easier, as we mentioned, to predict just based on interest rates, right? We know fundamentally those returns are going to be low in the near term, and that's the reality we have to deal with in portfolios. Stocks will be a little bit more unpredictable. We showed those periods in the 1950s. The difference today, of course, is stocks have had a nice run, and they're not real cheap. They were still relatively cheap in the 1950s. So I think we've got to take that into account as well, that stocks have had a nice run. They're certainly not historically cheap. They're not nearly as expensive as they were back in the tech bubble. So just throw that out there, that back in the tech bubble, they were more expensive and interest rates were still higher, right? We all forget that during the tech bubble, short and long-term interest rates were 5 and 6% versus today they're 0 and 2, right? So certainly that makes stocks look more attractive, right? You at least had an option back in the tech bubble. You could buy a bond yielding 5 and 6%. You don't have that option today, and that certainly helps stocks look more attractive, helps them maintain higher valuations for longer. But again, depends on how quickly we see those interest rates go up. That'll certainly hurt stock valuation. So I throw that caveat out there that we think the backdrop for stocks is still pretty good, but with a cautious eye, because we understand that it has been a good run for stocks. We'll eventually have a period of time where stocks will have a bear market type correction. And that's why we think now's the time to really think about building in some of that downside protection, right? Because nobody will ever perfectly predict in time those downturns, but you just got to make sure you're prepared to that, because there's nothing worse than talking about winning more by losing less and not have the portfolio deliver winning more by losing less.
Right. And great points. And we're getting so many good questions, but we'll end with this. You just spoke about an evaluation, whether certain stocks look expensive or cheap. Obviously that really depends on what also sectors you look at and so forth. So can you speak a little bit more about how the valuation looks from maybe a sector perspective, as well as how are stocks priced when interest rates are this low? I mean, one could make the argument that it's fairly priced or it's cheap. So just can you go over that based on the current environment?
Yeah, no, absolutely. I think, as you'd expect, some of those technology companies that have really led the way, right, the last handful of years, or really we can expand it beyond technology. All those growth companies, those companies that have grown really strongly over the last 10 years, those tend not to be cheap. Again, not at tech bubble levels of the early 2000s, but certainly getting to a pretty high end of their historic range from a valuation standpoint. You're seeing some of those other areas in energies, financials, where it's fundamentally cheaper. I always like healthcare. Healthcare tends to fall somewhere in between, where valuations are tremendously stretched. and you have a wide range of different type of companies within that healthcare sector. Some that tend to be naturally cheap, some that are great growers. So I think that's a nice mix from a sector standpoint, where valuations certainly still don't look tremendously out of whack. So you can find value out there. There's no question about it. There's areas of the market that aren't tremendously expensive, and I think those are areas worth exploring. We talked about some of those good quality companies tend to never be super cheap, but they're not super expensive as well. So I think that really helps build in that downside protection again, because I think one thing that we've seen historically is that generally higher interest rates and really high valuations on stocks don't mix, right? So I think that's some of the concern that we've seen play out over the last couple of weeks, is you get that dynamic where you've seen some of those technology stocks, you've seen the NASDAQ exchange, which is very technology heavy, come down and correct in a big way. It's really those interest rate fears. But again, I think as we get into the back half of 2022, maybe some of those interest rate fears start to recede a little bit, and we're on a more solid path for equity returns into 2022.
Great. Yeah, no, thank you for that. And we'll turn it over to Jonathan in a second. But as we evaluate for the next several years, we'll continue to focus on factors like profitability, stable year-over-year earnings, and those type of metrics where, again, I think really where any clients would evaluate those type of factors before buying businesses. That was really good parts that you covered. So thank you again for your wisdom. We look forward to continuing to work closely with you.
Absolutely. Thanks for having me on as always. Great questions, and happy to be back anytime.
Great. And Jonathan.
Mark, I want to say thank you very, very much to you and your team at BlackRock. Really, few things happened over the last 50 minutes of us talking. First of all, you managed to push up the markets by 400 points. So well done. When BlackRock talks, markets listen. Thank you. I'm inclined to keep you on for another 45 minutes so you can replicate that effort. So
it's that cash off the sidelines coming in, Jonathan.
That's exactly right. They're listening to you, Mark. They're listening. But really, also over the last 45, 50 minutes, what you've done, Mark, is you've reiterated our approach, our process, the fact that we rely on great minds and great resources like you, an independent fiduciary capacity that we observe relative to our clients, to employ the science of capital markets. There wasn't a single company name or stock ticker listed in your conversation, Mark. What you did for us and our clients, and you continue to do, is to use science and data to help us develop and deploy portfolios that will stand the test of time. And that's really what we rely on you and our other partners for in helping our clients achieve their financial goals. So Mark, really, on behalf of our entire team at RVW and our client base, which we serve, we want to say thank you to you and your team at BlackRock. Thank you, Mark.
Absolutely. Thanks, everybody.